Good day guys, and welcome to today's video. My name is Nifa Stacks, and in this video I'll be talking to us about the common mistakes beginner traders make in trading. Now, Forex trading offers great potentials, yet many beginners stumble into traps that lead to losses. So understanding these mistakes will make you profitable in the long run. Now, the first mistake is beginner traders fail to understand the importance of a trading plan, right? They fail to understand the importance of a trading plan. Now, one of the importance of a trading plan is that it helps to guide against emotional decisions. So, trading without a plan can lead to emotional decisions and to jeopardize your investment. Now, it is said that once you fail to plan, you are planning to fail. So in trading, once you fail to trade with a trading plan, you're already planning to fail, to lose your money and investment. So the trading plan also help you to understand your risks. So without a strategy, traders may not fully grasp the risks involved in the Forex market. So I can just enter the market and just place a buy and a sell randomly without knowing what I'm doing. So this is what it means. So you need a strategy to guide you. So I cannot be leading somewhere to profitability and I don't have a roadmap that follows, that helps me get to that place. So the strategy helps me to scale up, right? Now, creating a solid trading plan, a well-structured plan includes entries, exits that are tailor-made to your goals. So if my trading plan includes a 1:3 risk to reward ratio, I don't close my trade on a 1:1. And I don't hold my trade on a 1:10. When it is 1:3, I close my trade, and my stop loss is 1. I don't shift my stop loss because I feel the market will go up, or I'm hoping that the market will continue going down, but it's just a minor retracement and stuff. So trading your plan is the way to go in the market. So implementing risk management rules. So once you have a trading plan, your trading plan also inculcates your risk management rules to help you not to overexpose your capital, right? Now, setting clear profits. If I'm risking $50 and I'm targeting $150, it is precise. I don't say because the market is very bullish, I will shift my TP to $500. No, just make your profits clear and make your losses also clear. So if I'm risking $50 and my system tells me my stop loss is here, even if it hits me by 1 pip and goes in my direction, I am following the plan. So with this, beginner traders will also have a way to stabilize themselves when it comes to trading, right? So the next is understanding. They fail to understand how over leveraging works, how the word leverage works. They fail to understand what leverage does, right? So leverage is just a way of telling us that you have a control over a larger position with your little capital, right? So I have $100, but I can trade an equity of at least $100,000 or $10,000 depending on the leverage I use, right? So if I'm using a 1:1,000 leverage, my $1 is equal to $1,000, right? If I'm using 1:10,000, $2,000, my $1 is equal to $2,000. So if I'm having a $10 account, my $10 is equals to $10,000. So I can take a position that a $10 account can take with my $10, right? Because of the leverage I'm using. So leverage gives you opportunity to hold, to control larger positions and with your small capital, right? But then the benefit is that you can amplify your potential profit and gain. So of course you are using $100 and you are trading like $10,000. So of course you can make more profit, and leverage is a double-edged sword, right? Because it can also work against you if you don't know how to use it. So the way you can amplify your profit, you also what amplify your losses. So if I'm taking a loss of a $10 using a leverage of 1:1, I also amplify that loss, right? So the profit it would have given me will also be the losses it will take from me. So if I'm over leveraging on a trade, sooner rather than later, because I'm trading a $10,000 equity, but it is not given to me because the broker will not give you that kind of funds. So once I am on -10 or -100, which is my capital, the trade closes and I've blown my account. right? So the leverage can work against you if you don't know how to use it. And how do you know how to use it if you are not trading via your trading plan, right? So risk management, is very, very important. So never risk more than you can afford to lose. Prioritize your capital preservation rather than profit appreciation. So capital preservation is first rather than profit optimization, right? So I don't look at every trade as, this is what I would have made, this is what I'm making from this trade. No, is how much I'm willing to risk on this particular trade. So if I'm willing to risk $50 and I know I will not die, I know I will not be depressed, I know I will not commit suicide if I lose that money, then the trade is a good to go trade. But if I know that if I risk that $50, I might not sleep well at night, I will not eat for 4 days, now it is not worth it, right? Even if the potential gain is $1,000, it is not worth it. So why you have to stick to what you can afford to lose in trading, because of course trading is a probability game. You win some, you lose some, and in the advent of your losses, what if that loss is when you are now over leveraging and you blow the account and you don't have where to go again? So prioritize your risk management. Now, still on the topic of risk management, beginner traders hate the topic of risk management because they just focus on profit, 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 profit. So if I enter, I've had people telling me when I start trading, how much do I need to start trading? How much can I withdraw? How much will I get? Trading is not gambling. It is not a Ponzi scheme. It is a get-rich sure scheme, but not a get-rich quick scheme. So if you are coming all about the profit, chances are that you will not last long in the market. So many beginner traders fall into this trap of not learning risk management, right? Because they just appreciate, they just want to see the profit because the social media influencers, the big traders out there just post profit here and there. They just assume there are no losses in the game. So they just want to just make profits, risking their capital, right? Now, impact of high risks. Now, risking more than a small percentage can quickly result to a significant loss on your account. Now, the golden rule is to risk at least 0.5 to 1% of your account. You should risk at least 0.5 to 1% on your account. Now, the problem is you are funding a $10 account, you are funding a $20 account, and 0.5% looks small, 1% looks small, right? But then if you compound and over time the skill is there, you now understand what you are doing in the market, you are now a professional, or you now understand how the markets work and the whole thing about the technical, the fundamentals, and you're now a better trader. You can now go for prop accounts, right? Whereby your 1% that used to be $1 can now be $1,000, can now be $10,000, can now be $500. Do you get it? So the aim is not to just make money off of your first deposit. The aim is to gain mastery over time. So once you've gained mastery, funds will no longer be the problem because you have prop out there that will give you capital to trade and share profit with you. Now, the strategy should be a long-term strategy. Focusing on risk management contributes to a sustainable strategy. So I know that if with this risk management, so even if my strategy is 30-40% accurate all the time, I am still profitable at the end of the day, right? Now, emotional stability is also one of the things risk management will help you address. So effective risk management helps you to maintain emotional control, reduce impulsive decisions during trades. Over trading. Because of our impatience as beginner traders, many just want to just trade, quickly take profits, and that leads to hasty decision making. So I just want to overtrade, just get the trade. So they feel the more trades you take, the better your chances of winning. Meanwhile, in trading, it is quality of trade over quantity of trade. So I take 5 good quality trades as against 20, 30, 50 trades. Now, those 5 quality trades might have 1 or 2 losses, giving me a net profit of, with a good risk to reward, 15-10% at the end of the month. Meanwhile, trading multiple trades can even eventually blow your account, right? Because you are just trading anything that looks like the market is going up, bam. So chances are that you'll not even make 50% of the wins, right? So prioritize quality trades over quantity of trades. Now the consequence of overtrading is that excessive trades can result to poor choice and financial losses. So because I'm just overtrading, I cannot even, my emotions are all over the place, the losses are affecting me. I will make poor decisions because I don't even know what I'm looking at for. Because if everything I'm looking at looks like what I'm looking at for, I just trade everything I see on the chart. And trust me, you stay on the chart long enough, you would see something to make you want to take that trade, right? Now, decision making under pressure. So overtrading will make you take decisions under pressure because you just took a loss and the market is going after taking you out, you just buy. The market start dropping after taking you out and you're in a buy. You are not taking a sell, closing the buys to take the sell. And the market start buying again, you close the sell to take a buy. So you're just not settled, right? You're just not in the proper state of mind to trade. Now, strategic trade selection. So trade selection should be a selective trade. So any trade you need to open should be something you take your time to analyze and to trade so that you don't expose yourself to unnecessary risks and losses, right? Emotional trading challenges. Now, this is very important because many a times we just say that as traders, you need to kill your emotions. You don't need to have emotions to be profitable in the market, blah, blah, blah. But the truth is that everybody has emotions. We are emotional beings. Now, one of the emotions traders new traders have is the emotion of fear and greed. Now, fear will make you FOMO. You want to take the trade, you don't want to take the trade, and the trade is going against you, or the trade will not come to your entry. You enter the trade too early or too late, right? You also fear of taking losses also. So because you fear of taking losses, you don't even take trades. You're just paralyzed when it comes to taking the trade. Now, greed will also make you hold on to profit so long. So I'm supposed to do 1:3. I've done 1:3. I'm still holding. I know it will still keep going up or it will still keep going down. I know the market will go down, this and that. And you violate your rule, hoping that that trade will give you the breakthrough you're looking for in the financial market. And you realize that the market will not turn against you and go to your stop loss. So greed can make you hold on to trade for so long. Also, we also have what we call hope. Hope will make you hold on to losing trades, right? I'm like, no, it will still go back up. It will still go back up. It will still go back up. Meanwhile, your strategy is telling you that to close this trade, your stop loss has been hit, but you're still shifting your stop loss to accommodate. And sometimes you might even still keep funding your account so that you want to recover the loss you've made already. And this is emotions. So panic selling. So beginner traders often panic when trades go against them, resulting to losses. So trade is going against me, I'm panicking, I'm closing my trades. I don't expect the trade to be in red, but I just open the trade and it's going against me, I close my trade. Before you know it, the trade recovers and start going in profit. You just closed losses, holding on to losses. So the trade, I've just explained that you are hoping that the market will reverse. The market is going against you. You're still hoping that the market will reverse. So emotional decision making. So emotions could cloud your judgment, leading to impulsive trade action. So once you're having all these things running in your head, you feel like, this will buy. Your strategy is not telling you that it will buy. Your strategy is telling you to wait, but your mind is telling you it will buy because it's showing you bullish candles, very big, heavy bullish candles. You're like, no. The market will go against, go and leave me. So I just need to enter the trade. So sticking to a strategy. Once you stick to your strategy, it will help you curtail these emotions. So if my strategy says that I'm waiting for a break of structure and I've not seen that break of structure, I don't enter. Even if I'm feeling in my heart that it will buy, it will sell. If I don't see that break of structure and return to, let's say, a PDR raise, a breaker block, a mitigation block, a fair value gap, or an order block, or a support and demand zone, if I don't see that break and retest, I'm not entering that trade, right? But your emotions can tell you just enter, it will do it. So if you enter here, you're going to be in more profit before other people start entering the market. That is your emotions playing tricks on you. And once you do that, you're not going to be consistent. So your emotions will make you enter here, enter there, and in the long run, you might not really be profitable using that same strategy over time. So what you need to do is to focus more on building a system, a strategy, and you should stick to it. Now, the using of stop loss. Many traders tell you that they don't use stop loss. You come and say that I don't trade with stop loss. Okay, if you don't trade with stop loss, I wish you well. But as a beginner trader, always trade with stop loss, right? Stop loss will make you avoid unnecessary losses in the market. Now, also have what? Understanding of the market trend. Now, in Nigeria here, we say the police is your friend. But in trading Forex, the trend is your friend. What you have no business selling in a bullish market, and you have no business buying in a bearish market, except if you are trading the reversals, of course, or you are trading the retracement, right? But overall, because you don't know when it will retrace, how it will retrace, as a beginner trader, focus more on the trend. So if you see a reversal, continue buying the market or continue selling the market after the reversal. If you see the market forming higher highs, when it forms a higher low, you buy. Don't try to pick the higher high to the higher low. No, don't trade against the trend. It will help you save your money, right? It will help you stay longer in the market. So don't ignore the trend. Always focus on the trend, and always focus on the higher time frame, because the higher time frame what controls the trend in the market. So don't focus on the 1 minute trend, even though some people scalp the 1 minute trend. But then once the overall direction for the day is bullish, you expect to buy throughout the day, right? So you can even jump to 1 minute or 5 minutes and look for more buy entries and signatures, right, to give you profit. But if you are bullish and you're looking for sales, I don't know what you are doing. You just want to catch the buys and the sells, the buys and the sells. You can do that, but over time, you have to become a professional, right? But as a beginner trader, don't do that. Don't try to catch every move in the market. So once you trade against the trend, you are going to make more losses than profit. Now, the trend is your friend. So trade with the trend and make more money doing that, and avoid unnecessary losses from trading against the trend, because in the end, the trend is your friend, right? Now, understanding poor risk to reward ratio. So many beginner traders don't know what a risk to reward is, right? So they just place a buy, they don't even know how to calculate their stop loss. They just want to just take a trade and let's see how much we'll make, right? So a trader might be risking $100, but when he makes $50, he's happy I'm in profit. I made $50. $50 is not even up to the 1:1 of that trade. You have not even done 1% of what you are risking. So you want to risk a certain percentage to get, at the very minimum, the very least, 1:2. So if I'm risking $100, I should be aiming for at the very least $200, right? If I'm risking $50, I should be going for at least $100 before I take my profit. So you should work on your risk to reward. So it doesn't make sense if I'm risking 100 to get 50. At the very least, I'm losing, right? Or at the very best, I'm still losing. So I need to win 80 to 90% of my trades, if not 100 and 150% of my trade, to be in profit, because one loss will wipe out 2 profit I've made, right? But if I'm risking one is to get 3 or to get 2, I still have a chance, because if I lose 4 trades and I win 4 trades, I'm in profit, right? If I'm doing 1:3 and I lose 3 trades and I win 1, I've broken even, right? So a very good risk to reward helps you to stay longer in the market. It helps you to retain and preserve your capital better, right? So consistency in maintaining this risk to reward will save you. So don't risk 50 today, risk 20 tomorrow, and risk 10 next tomorrow. It is not consistent. So you cannot really track your progress like that. So if you are risking $50, let it be $50 across the number of trades you want to take on that account, right? So if it's 10 trades I'm taking or 20 trades I'm taking, I'm risking this amount, let it be that amount over time, so that you can track your growth, you can track your process and your percentage wins, right? Your win rate and losing rate, and you can also know your losing streaks and how you are navigating through them, right? Also, one of the downfall of many traders is that they neglect news events. One of the first things you should do as a trader is to go to your Forex factory before you even take a trade, so that you know if you're expecting a high impact news during the market, you are expecting a low impact news, or the banks are on holidays and stuff like that. So if you have these things, because the news if affects the currency you are trading. Let's take for example you're trading USD JPY or Euro USD or GBP USD. Now, and Donald Trump is having a speech. You don't know. He says something that affects the economy, or he gives a law, just like when he talked about increasing tariffs and stuff like that. We saw that the dollar was going down. You might have a bullish setup, and your strategy might tell you that yes, it is bullish, but because of these events, it can counter your strategy. That will now be the time that your strategy will fail you because of the fundamentals, right? So the news events are the fundamentals. So you need to always follow the news events. So if you're not if you're not a professional trading high impact news, as a newbie, avoid it. Avoid news trading, because you see people online making millions, hundreds of thousands of dollars trading NFP, CPI, FOMC, and the likes. You have not gotten there yet. Don't do that. You cannot sustain it. You don't know what it takes. You don't know how or what is moving the market during those periods. So just avoid those things so that you can be safe. So avoid high impact news if you are not proficiently trading it, or you are not a professional trading those news, so that it will save you a lot of emotional stress, and it will save you a lot of emotional traumas, right, as a beginner trader. Now, avoid trading too many pairs. The number of pairs you trade does not really make you a professional trader or make you a better trader as a beginner trader. So you should try to work more on focusing on the major pairs. Let's say the GBP USD and the Euro USD. 1 to 2 pairs are okay as a beginner. So once your focus are thin and on just those 2 pairs, you understand the currency pair very well. You understand how the currency pair reacts. Then over time, if you have built consistency in those pairs, you can gradually expand and add other pairs to your trading pairs, right? So you don't need to start looking at too many pairs at the same time as a beginner trader, because you get yourself confused, you get yourself mixed up, you get your strategy mixed up as well. So just focus on 1 to 2 pairs, and once you are good, and over time you can keep adding pairs as it suits you, right? But as you are a beginner, don't focus on too many things, don't focus on too many assets. Just 1 or 2 is okay for you, because the same money 1 pair will give you, multiple pairs will give you. The only difference is that you have more opportunities watching multiple pairs. And as a beginner trader, if you watch multiple pairs, it will lead to over trading, because you want to trade everything you see on every asset pair, and it's not healthy for your account, right? So avoid trading too many pairs and learn to focus on 1 or 2 pair, preferably the major pairs like the Euro USD and GP USD, right? Now, beginner traders also forget to journal their trades. This is very important, because not even all professional traders journal their trades. Now, many traders neglect to keep record of their trades, and this limits their ability to learn from their past experience. So we think because I made this mistake, I'll remember when I'm taking the next trade. No, journal it, go over it over the weekend, so that you can see what you did wrong, what you are doing wrong over time, and correct it, right? So what are those things you need to include in your journal? Number 1, you need to record your trade details, the strategy you used to enter. Let's take using Asian range. So I just put Asian range. I'm using fair value gap entry. I use a fair value gap. I'm using the breakout block or the mitigation block. And these are strategies that have been taught on this YouTube channel, right? So if those are your entry patterns or your entry models, you just list it and the time and the zones you're entering. So if you're entering in the London kill zone, the New York kill zone, you state it there, right? Your entry and exit. So you enter when this happens and you exit when this happens, right? You state it there. Your risk to reward ratio is also there. Now, how you are feeling emotionally before you enter that trade. Were you so optimistic? Were you so sure that the trade will hit CP? Were you so happy, right? You write it there. Were you sad? Were you just, I just want to take a trade. I just feel like taking a trade. I'm angry. Write it there. How you are feeling during the trade, when the trade was going against you. Did you feel like closing the trade? Did you feel like ending the trade? Did you feel like just offing your laptop, offing your phone, just going to do something else, go and swim, go and eat food? Were you stressed when the trade was going against you, or did the trade just go directly to TP after placing the trade? Now, what happened after the trade also, you have to document it. Were you so happy that you didn't close the trade when it was going against you? Were you glad that you hit the stop loss but you followed your strategy? Do you get it? Those are the things you put on your trading journal to help you become a better trader, right? So after you do this, over time you start seeing those emotions and know how to correct them, right? You now refine your strategy. You will now be able to regularly review these journals to identify the patterns in your trading behavior that needs to improve. So is it that anytime I take a trade and it's going against me, I'm always on the edge? So what do? I just take the trade and set it and forget it, right? If that works, it will help me to control my emotions better. Or I tell somebody, if I have the tendencies of overtrading when the trade is going against me, tell a friend or accountability partner, I'm taking a trade and I don't want to take another one, so hold me accountable if anything happens, blah, blah, blah. Those things will help you grow as a beginner trader. Now, key strategies for Forex trading success. The first and the foremost is that as a Forex trader, you need to be disciplined. The more disciplined you are, the better your chances of making profit from the market. The disciplined traders are the traders that are consistently profitable. The indisciplined traders are the ones that do hit and run. Today they're in profit. You don't hear from them until after 3, 4, 5 months. You see another screenshot of profit, and they're just here, they're just there, anywhere. But the disciplined traders are those traders that follow their rule and they are strict with what they do. They trade their systems like robots, right? Now, they develop also a solid strategy. As a disciplined trader, you also have a solid strategy. So these are the key strategies for trading successfully as a beginner trader. So if you don't have a solid strategy, you have no business trading. Look for a strategy, implement risk management, and be disciplined, and you are golden. Also, you also learn from your mistakes. Don't just trade and forget about it. And today was luck, tomorrow was luck. No, luck happens to people that are very disciplined in the market, right? So their luck will create room for them. So luck does not just happen to anybody, right? If it's luck, create your own luck, right? Be disciplined, work on your strategy, refine it, and remove those shafts from the strategy, right? Don't do the normal. Don't do the normal. Be disciplined. Be consistent. So if it's breaker block I'm using, mitigation block I'm using, favor lookup I'm using, I stick to it because it works over time, right? I stick to it and I don't change from breaker to mitigation to favor lookup to other blocks to trend line to supply and demand. I'm not everywhere. Disciplined trader is someone who sticks to that which he has found that works, right? Also, you should practice patience. It is very boring when it comes to waiting for a system to play out. It is very, very boring. So because I'm waiting for my setup to form, probably I'm waiting on an hourly time frame or a 4 hours time frame. It can take 2 days, 3 days for the setup to form, right? So within those 2 days, 3 days, I can be so bored and tired. So in those times, because I'm not disciplined, I might start looking for trades in between just to scalp and to suit me, like to just pamper my ego and to pamper my emotions, right? No, don't do that. So you need to have patience, practice patience, right? Take your time and wait. Ensure that you're so disciplined that if you don't see your setup, and even if your setup is past, you didn't see it when it was happening, you just let it go, right? Even after waiting for it for like a week or 2 weeks. So patience will allow traders to wait for the right opportunity instead of forcing trades. So you keep your emotions in check. Controlling your emotions is vital to prevent them from interfering with your trading decisions. So if your emotions are in check, it would help you to take decisions with a clear mind. So if your emotions are in check, it will help you to trade with a clear mind. So this will be all for this video. If you like this video, do like, subscribe, and share this video, and I will see you in the next. Cheers and God bless.